Welcome everybody to Navigating the Minefield, where I chat with Eric Majinski about his views mainly on miners, but now also after last week's episode, increasingly on the crypto space. Hi Eric, how's it going?
It's doing great, Roger. How are you?
I'm very, very well, thank you. Now, obviously, before we kick off, I need to say that this is not investment advice and everyone should do their own research. We're doing this for education purposes. Everyone has their own investment horizons and reasons for doing these things. So do your work around that. But hopefully we can give you some pointers and tips along the way. Now, what I really wanted to get into is, after last week's episode where you kind of outlined your view on the crypto space, quite a lot of comments were telling me that I should bite the bullet and get involved in buying at least some Bitcoin, which I guess you would wholeheartedly endorse.
Well, I mean, listen, the goal, it seems, of the series is to convert you maybe not into a crypto degenerate like some of us, but to at least have a little bit of Bitcoin. That doesn't seem so unreasonable now, does it?
There's a couple of things that I've been sort of thinking about, not so much on me getting involved, but actually just thinking about a couple of scenarios, because whilst we've been talking about gold, etc., gold has actually been meandering around just around those all-time highs, so sort of 2000 to 2070. But I was wondering, hypothetically, from your perspective, let's say we got a big move breakout in gold, and at the same time we got a clear building momentum back up on, let's say, the Bitcoin and the crypto space. How would you then apportion your resources, as it were, if you had two very clear and dynamic opportunities? Let's say this time gold also got those gold miners going. So let's say in 2 or 3 months, you've got Bitcoin on the move, you've got gold and gold miners on the move and silver on the move. How are you going to split your resources in that environment? How are you going to decide where you're going to put your cash?
Well, the tricky thing, I guess, and the reason why we have these, talks, hopefully with some good ample runway to make decisions, is because if you did not prepare for that occurrence over the course of the last year or more, it's not as simple as I'm going to switch everything, unless you're just going to play, the BTC ETF and you're going to buy the GLD or, GDX, and those are your two different vehicles, which are boring and are not why I'm here to talk at all. But if you look at even the top 50, top 100 tokens, on the crypto side, you're not going to go and want to be having your back against the wall that these scenarios say give us the full go-ahead trigger that you're trying to chase at that time with every other pleb. Sorry, if you run a hedge fund and you're doing well in life, in that case, you're just a sheep and you're essentially behind the curve, which is not what we're here to talk about. We're talking about being ahead of that curve and being positioned. So it's about doing the work and doing the research and doing what you need to do to prepare for that scenario. And actually, I think getting started a bit when you're either comfortable enough or confident enough that you're pretty sure, like, look, this is an area that I want to be in. It is an area I want something in. I just don't know how deep it is. I'm going to go in. You need to get that all rolling. In 2020, where we have seen in one day in that March, Bitcoin was actually, I remember this vividly, it was holding in at 8,200 to 8,500, while the rest of the world was melting down to nothing. You had equities crashing. Everything was just getting pummeled. And I said to myself, there's no way that the highest risk asset is going to hang through this and not get destroyed. I remember I have lightened up a good amount. I mean, 40% of my position hit the market with the Bitcoin over 8,000. I took a nap later that afternoon and woke up and it was at 4,100. And that was the day that crypto crashed 50%, Ethereum and Bitcoin in one day. And it actually happened within hours. And I remember just getting the grog out of my eyes and going back to my Coinbase account and just trying to buy. And the system was very clogged at that time. So you were having delayed orders, the screen was freezing up and things like that. But after we recovered from that, we went into a steady climb, which was the impetus actually for Bitcoin to make that first run in the spring of 2021. So not even, 9 maybe months later, we would hit 65,000 or so. And so along the way, when I was getting louder and louder at the Gold Investment Letter on our YouTube channel saying, listen, I was starting to get pretty aggressive because my conviction was there. This is the last time you'll be able to buy Bitcoin potentially under 8,000, under 9,000, under 10,000. I remember getting very aggressive one particular day and saying, there is a very high possibility. I never guarantee these things, but I'm like, there's a very high probability you're never going to see Bitcoin below 10,000 ever again. And it actually has never gone, knock on wood, to this day, under 10,000 ever again. What I ended up doing is I said to the doubters out there that were smart money but still weren't convinced, I said, do this for yourself. Open an account. Open the account, get your KYC and all these things done and approved by Coinbase while we have this lull in the activity in the market. Move money over from your checking account or whatever account you have for your business and move it out to the Coinbase platform. I said, any and every real trader out there wants Bitcoin, if and when it does break through the late 2017 high of 20,000, that's around where it was going into 18. When it breaks that all-time high again, you're going to get a lot of momentum traders, a lot of breakout traders. That's a very big signal. And so Bitcoin at that point, my call was that it would go up 30 to 35%. What I had done is I warned them, good luck trying to do it when it happens. You will get nothing but a shutdown on Coinbase's account that says we're under maintenance because we're getting flooded with people trying to do what you should have done weeks ago. And this still happens to this day. So based on your question of like, what would you do? I've already been doing it. I've already been anticipating this. My overall investable assets, I think in crypto right now, they're between 55 and 58% of everything that I have. That was 40 and maybe under 40 not too long ago before the rally kicked in 2023. Where you've got more of still the destruction that has not cleared the shelf yet is in the miners area, which is what we're waiting on.
But you also raised a very interesting point there, which is, about, if you try and trade in these moments of mayhem, you may absolutely miss it. I remember in 2008, this was just on the S&P futures, but volumes that went through the market in September and October of 2008 was so high that I just remember client orders just not getting filled because the volume was too big for the system. And although technology has obviously improved significantly since then, so has all the volume that can be put in from various sources. And so you nearly always get this clogging up in those moments because, there is a risk that you won't get filled. You'll have standing orders, they'll get missed, or they'll just not trade. So it's definitely worth, as you say, not having some positions on beforehand, because trying to trade markets that are swinging 10, 20% in a single day is a miserable way to make an existence. But kind of going forward now, thinking of this year, we've been looking for this policy from central bankers. And what I thought was interesting is that quite recently, the expectation for recession was very, very high, almost completely gone. And that's nearly always contrarian, because almost always before a recession, everybody thinks soft landing or no recession. And we just got back to that spot, which probably increases the chances that 2024 might be the year when the recession occurs based on that historic data set. Because we still really need policymakers to come in with the blunderbuss of liquidity to really kind of put a rocket up the bottom of all these sorts of assets, don't we?
Well, it's an interesting thing you said that, because right beforehand I was looking and I woke up last night and I'm thinking about the VIX. And I'm like, where's the VIX? I haven't seen where the VIX is trading anytime recently. So I wake up and I'm taking a look at it. The last time that the VIX was this low, 1270 or somewhere in that ballpark, was January 12th, 2020. And we know what happened right after that with COVID, right? So then it was up 55% in, just very, very quickly. But you also had the previous time before that, when the VIX was just over 10, was Valentine's Day of 2007. We all know what happened in 08, 09. But if you talk to anybody in 2007, what was the outlook? Roses and flowers and angels and sunshine. And everybody's now talking like soft landing is all in the clear. Inside of me, I'm thinking to myself, this just doesn't seem like I want to be a part of buying fully into that narrative. It seems irresponsible to me.
For the blunderbuss, the proper blunderbuss, it nearly always takes a proper shock, an exogenous shock, like we saw with COVID, which was a true exogenous shock. I think if it was a common or garden slowdown into a true recession rather than what we've seen this rolling recession, they may take a little while to really kind of fire up the cylinders, as it were, because, a recession historically has always been a cleansing mechanism. Now, obviously, timing of recession and elections and all the rest of it does make it a little bit trickier to try and contemplate at the moment. But it is, you're right, we're in this very unusual scenario where I think that the S&P has gone through one of its longest, not longest ever, but one of its longest periods without a 2% drawdown. So again, VIX is low because there's just not really been much downside. To your point on 2007, I think even in 2008, in the summer of 2008, I may be incorrect, but I think the VIX dipped briefly below 20. Obviously, it'd been a lot higher because it had bear stearns in March of that year. But again, it briefly dipped below 20, and you had oil going to 150 because everyone thought, oh, we've got the worst of it behind us again. Where we've got to go this year is the unemployment that matters. And at the moment, you're getting very, very, very low levels on initial jobless claims. We're not seeing the sort of movement in the unemployment market or the employment market that is commensurate with a true common or garden recession, which hits enough of the US economy. But what the Fed's been very good at, and I think we forget this, but they've done this macro-prudential stuff, which is it's not just about monetary policy anymore, interest rates, etc. And let's pretend QE is monetary when it's not quite. But what they do is things like the bank fund, the BTFP, which came in back in March of 2023, and that really reduced some of the volatility in the bond market. They're very, very good between the Treasury and the Fed at doing a lot of backdoor liquidity, which is what I think one of the reasons why things like gold is near the all-time highs, despite the fact that we had those real rates, which were, going against gold itself. Because you have this liquidity, and gold and precious metals, they love liquidity. And whether it's going to be interest rates per se, or if they just continue to make sure that there is decent liquidity out there, then maybe that's the reason, and one of the arguments that maybe we don't get a proper recession because we never get everything coordinated together. What we've been getting is a bit on the East Coast, a bit on the West Coast, a bit in that sector, a bit in that sector, some households, some small businesses, but not all at the same time, with that underlying current of reasonable liquidity. We all have to keep our eye on liquidity. I'm being told by most sources that it's going to stay pretty good over the next few months, and maybe many, many months. And so that suggests that actually maybe there is a risk that we avoid the recession. But if you avoid a recession, you then increase the risk that you get wage inflation and true inflation, which might force the hand of the Fed. But it's a very, very difficult one. It's the reason why for the last 24 months, there have been incredibly plausible arguments for recession and incredibly plausible arguments against recession. And we still haven't resolved that yet.
You said it, back door, back alley liquidity, like the back room liquidity of the Fed. Like that's what they're doing with the banking sector and all the loans that have been floated there to create better solvency for all the out of the money bonds that are sitting there on these balance sheets. And we started to see some explosion, some pain that was popping up because of this extended rate increase environment. And so they're doing things like that to stimulate liquidity. They're just not, they're on the back page of the bottom of the obituary section in the Wall Street Journal. To me, the discussion of a recession or not is just useless and it's a distraction. I hate to say it that way, but who gives a shit? Like you could argue that we were in recession in 22 and started to suffer all of that time in terms of the market environment, even though the data didn't necessarily officially put us there for some people, but it was for others, that was the recession. And so then what do? You look forward. And it seems to me like the one common denominator, whether you get a recession, a technical recession, whether you get a soft landing, a hard landing, a no landing, I think as you said, then the only thing we know that either way, because whatever it is right now, they're still doing what they will continue to do, which is flood liquidity, whether it's flowing liquidity, so it's not called flooding with liquidity, and it's kind of steadily coming in to keep things okay, or whether they need to turn those spigots really on in a powerful manner, All of these things are good for, for assets in at minimal nominal terms. And there's nothing in any scenario with or without a recession having already occurred, about to occur, or going to occur in the future that is going to change the fundamental cluster that we're in, which is a completely debt-ridden society. And that's not just in the US, but I mean, we're over 130% of GDP and climbing rapidly just based on the interest we're paying on the debt. This is a very big issue. Like that, everything else is almost conversation, right?
Obviously, some people, you talk about how you build the positions and you don't time it. Some people will still think about timing. And I think the biggest, maybe not the biggest risk, but a particular risk out there at the moment is simply that the Fed effectively has to force a recession, not necessarily wants to force a recession. I don't think they ever do. But for instance, here's an example that might happen. We get no landing, soft landing. They've got that liquidity story, which is great. But you've got some issues, with the Red Sea at the moment, with the Suez Canal. Maybe you get an inflationary spike, which they can't control because it's a supply side story at this stage in terms of shipping. But if you have an economy that's doing okay, starting from the level of unemployment that we have, and even the level of inflation that we have, then there is a risk that the expectations for rate cuts in 2024 disappear and actually rate hikes come back onto the table. Now, that's a long, long way off at this current moment in time. And the point here is that timing it and then timing it through one of those mega moves is going to be tricky for everyone and anyone. So therefore, that's, goes to the argument of have something on in advance, as long as your time horizon is correct. I mean, if you've got a few year time horizon, great. If your time horizon is 1 year, then you'll have to look more at trading this sort of stuff.
The window of the best buying opportunities, it's in the environments when people just don't want to talk about it. They don't want to act and they hate the sector. And then all of a sudden that sector's going to zero. I think the first video you and I did where we talked about the building a framework around the mining sector, the first comment was, get ready to lose all your money. Because it was like, they've been in a bear market for 3.5 years now, and it's been a pretty nasty one. So clearly, what is my timing? What do I think we have for timing? I'm going to focus on where do I know or feel like I have some level of good understanding and or information and or flow and edge in a sector. The timing for that sector to be looking and to be shopping and to be doing your work is right now. We've got literal commodities and precious metals of actual value that are in the ground that these companies own. I was buying a little bit too early, in that space when I was even rolling some of my big crypto profits from the end of 2021. I started going into some of the junior mining stocks. Some of those are cut in half on unrealized losses. Since those days where, I'm literally talking about, a few years ago now. So basically 2-3 years ago when those were being purchased, I've had winners in that time that were purchased then too, but those were more the anomaly, not the whole sector that has continued to grind down. And now when I see the same deposits, it's the same thing. There's still that much gold there. There's still that much nickel in that deposit. And the company, has only issued X amount of shares. So what's the difference? Like, has the story gone out of the window because all of a sudden the business model doesn't work? That not in that space. You don't need to worry about that particular piece. It's a shitty business overall. Yes, but that's why it's also so opportunistic when everybody around you is like, you're a moron for being deep in that space. And I get plenty of that, Roger. The you're a moron reader for me, the Vixie of you're a moron for being in this space is at all-time highs right now. That's all I know. Like if I'm on a phone call or run into somebody who's sophisticated at a restaurant and meet them, oh, you're in the mining business? You know what I mean? So it's those are the timing things that I like, which are the ones where you're literally you're taking positions in things longer term when the bloom is off the rose, so to speak, a bit. Or when it's just starting to get that momentum and you're getting evidence that you were correct. I push the envelope then.
Hopefully over the next few weeks, you're going to be talking to people who have been embedded in this space for years, if not decades, because you talked about the skeptics. Well, the skeptics want to understand this space, you're going to be talking to hopefully a few of the legends of the space, because we're going to add another element to this series, which is going to be you, Eric, interviewing some of the people who have been in the mining space for many years.
There are going to be some of the best superstars, phenoms, if you will, that have been in this business for definitely decades, not years. I mean, these are veterans that have made their wealth, which is, you put it up against any, ballers in any industry in terms of like actual wealth creation. They've done it in the mining sector. And I'm so excited about that, because what we're going to do that's a little different is, instead of just talking to them about what they think about gold, what's the data saying this week versus next week type of thing, we're going to hear about their stories. What, some of the cool stuff, the fun stuff that we want to hear as, just individuals watching a good movie. Where'd you get your break? How'd you get into this? Some of these people, even like myself, when I look back at the saga of where, what brought me in the door of the capital markets and then continued on, there's some very beautiful and heartbreaking moments, that have gone through that. And that's what I want to get into with these guys. And then the most important part or feature, I think, of these interviews, as you had pointedly mentioned a couple of weeks ago, it's sort of the subset of what is the absolute, winning mindset to invest in the mine field. And that just goes to also to speak to volatility. That's what we're dealing with here. It doesn't have to just be about mining. It's about, dealing with areas where one year, 1 month, 1 week, you're the king of the world. And then 2 years later, a month, that week or whatever, you're a pauper and you're thinking about where's the best place to sleep under cover in the alley, because I got to make it through to the next time I have some hope. So that's what we're going to get into with those gentlemen. And that's where I'm super excited to learn.
I'm looking forward to that too. I think it's going to be the real passion of the people in this industry. And I think our working title is The Miner's Mindset, and it is all about their mindset. So very much looking forward to that, and seeing you having a chat over the next couple of weeks.
Hey, thanks, Roger. I appreciate it, man. Have a great day and great week.